Good day, students. And today, we're going to discuss stocks and bonds. Content standards. The learners demonstrate understanding of basic concepts of stocks and bonds. Performance standards. The learners are able to use appropriate financial instruments involving stocks and bonds in formulating conclusions and making decisions. Learning competencies. After the session, the students are expected to Number one, illustrate stocks and bonds. Number two, distinguish between stocks and bonds. Number three, describe the different markets for stocks and bonds. And number four, analyze the different market indices for stocks and bonds. Lesson one, stocks and bonds. Stocks and bonds are the heartbeat of the economy. Much of the world's business activity would be impossible without stocks and bonds. But whether you trade on the Philippine Stock Exchange, financial terms can always be confusing. So before you invest in a stock or a bond, you need to know what is the difference and which one should you choose. Stocks and bonds are certificates that are sold to raise money for starting a new company or for expanding an existing company. They are also called securities, and people who buy them are called investors. Stocks. Companies sell shares of ownership in their company to raise money to finance operations, plan expansion, and so on. These ownership shares are called stocks. The buyers of the stocks or the stockholders receive stock certificates verifying the number of shares of stocks they own. The two basic types of stocks are common stock and preferred stock. Common stockholders have voting rights. Preferred stockholders do not have voting rights, but they receive preference over common stockholders in dividends or payments from profit and the company's assets if the company goes bankrupt. Stock market provides an orderly trading place for stock wherein prices or market value vary from day to day and within a day. Only stockbrokers who specialize to work in the stock market can trade on the floor. The broker receives a commission for the services of both buying and selling stocks. Bonds. Sometimes companies raise money by selling bonds instead of stock. When you buy a stock, you become a part owner in the company. To raise money, companies may not want to sell more stocks and thus dilute the ownership of their current stock owners, so they sell bonds. A bond is a form of long-term investment issued by a corporation or government where the purchaser becomes a creditor of the company. It represents a promise from the company to pay the face amount to the bond owner at a future date, along with interest payments at a stated rate. The company, state, or municipality that issues the bond is called the issuer. The annual interest paid by the issuer to the lender or the bondholder on the bond is referred to as the coupon. The coupon rate is the annual payout as percentage of the bond's par value. Bonds have two kinds of values. These are par value and market value. The par value of the bond is the same as its face value, while the market value of a bond is the price at which the bond is being sold. It may be greater than or less than the amount of the par value. If the market value is greater than the par value, then the bond is selling at a premium. If the market value is less than the par value, then the bond is selling at a discount. Let's differentiate stocks from bonds. Basis for comparison. Definition. For stocks, it is a form of equity instrument or raising money by allowing investors to be part owners of the company. For bonds, it is a form of debt instrument or raising of money by borrowing from investors. Issuers. For stocks, the corporates. For bonds, government institutions, financial institutions, companies, etc. Status of holders. For stocks, shareholders are the owners of the company. For bonds, Bondholders are the lenders of the company. Forms of returns. For stocks, profits earned by the company are paid in the form of dividends. For the bonds, interest payments are made in the form of coupon payments. Risk level. Stocks. The risk level is high since it depends upon the performance of the issuer. So no guaranteed returns. For the bonds, the risk level is relatively low since bondholders are prioritized for repayments. Major risks associated. For stocks, market risk, business risk. For bonds, interest rate risk, inflation risk. Additional benefit. Stocks. Shareholders get the right to vote. Bonds. Bondholders get the preference in terms of prepayment and on liquidation. Market value. For stocks, when interest rates fall significantly, the market stock value rises. For bond, when market interest rates decrease, the market value of an existing bond increases.